Hello and welcome to my Q1 2024 market update and market outlook for Q2 and the rest of the year in 2024. I hope that the year is off to a great start for you. I hope that the first quarter has been a positive one. It certainly has been for most global markets. We've seen the United States, the Eurozone and Japan have a very strong start to the year. The Australian market also quite a positive start for the year, with China and Hong Kong being the more lackluster markets to kick off 2024. We have seen the Magnificent Seven, or the technology giants in the United States, leading the charge again, but we are also seeing a lot of divergence amongst that space, particularly in the United States as well, with the likes of Tesla down around 35% and NVIDIA up closer to 80%, as more and more focus and attention is paid to who will be the biggest beneficiaries of the growth in the AI space. We have also started to see inflation in Japan. We've seen a number of policy changes, which we'll touch on in this update. And as a result, some very positive returns in terms of Japanese equities. But it has been a year where it's been all eyes on central banks, certainly as to when we may get the first rate cuts. Again, inflation remains sticky in most countries around the world, but it is very likely, as we are seeing from most commentary, that we are well and truly past the peak of the rate cycle and eventually will start our way down as interest rates start to get cut. So in this update, we're going to have a bit of a look at the key regions around the world, where we see opportunities, what the outlook looks like for the rest of this year, and of course the second quarter. I hope you find it helpful. Let's dive right in. Starting off with the United States, we have seen some fairly positive economic data in the first quarter. We are seeing inflation continue to freefall, which is excellent news for the United States. As energy prices have softened, that's obviously been a big win for inflation figures in the US. We are starting to see a bit of an increase in credit card defaults, personal debt levels. However, this doesn't look terribly concerning, and it looks more and more likely that the United States will avoid a technical recession or any sort of meaningful recession in terms of the economic data there. We are also seeing quite positive levels of consumer confidence and confidence around just general corporate earnings. Most analysts are expecting that corporate earnings in the United States will increase by at least 10% throughout 2024. That is what we are seeing priced in. We're seeing the S&P 500, the NASDAQ achieve all-time highs almost on a weekly basis. We're seeing another announcement, which is only natural as these companies continue to grow, particularly in the technology sector. We are also seeing some more and more positive activity in the small cap space in the United States and the rest of the developed world. The small caps were hit hardest when interest rates started to rise on the back of rising inflation. And so far, year to date, we've seen the small cap US index up around 6 to 7%, depending on exactly what date you look. But we are starting to see more and more capital flow in there as we are getting closer and closer to the first rate cut. Now, the Federal Reserve has really sort of hinted, I guess, around when that rate cut may be. Some analysts are still expecting that we'll get the first rate cut as soon as Q3 of this year. So potentially sometime between July and September, which naturally would be a big positive for markets in the United States. Now, naturally, it is also election time, election year, so we are all seeing the campaigning. There'll be plenty of activity. Generally speaking, an election year is a positive for markets because we tend not to see any meaningful policy changes. Nobody really wants to rock the boat when there's an election on the cards. So we're not expecting anything to be terribly different this year. But of course, all eyes on the Federal Reserve as to when we may get the first rate cut, and of course what that does to the US dollar, particularly for us relative to the Australian dollar. If the Federal Reserve does start to cut rates more aggressively than the RBA, then we may see that the Aussie dollar strengthens or the US dollar weakens relative to the other currency. So in the United States, we remain bullish on healthcare, technology where there is genuine substance, strong free cash flow, strong return on equity, and manageable or low levels of debt. We like cybersecurity, consumer staples, and very much where the technology giants are expanding into new sectors like agriculture, like health tech, and of course, financial technology as well. So let's have a bit of a look at some of the other regions. Now, looking at the Eurozone, again, we are seeing a similar inflation story play out here. Inflation is free falling, energy prices have been declining, and we are starting to see the Eurozone's inflation rate get closer and closer to the European Central Bank's target of 2%. Now, this is quite remarkable given we were only in the 8s and 9s not that long ago. So, great news for inflation and, of course, interest rates on the back of this. The UK, we are far less bullish and excited about potential policy changes, potential tax changes, and of course, we are continuing to see the flow-on effects of Brexit in terms of corporate earnings. So we are sort of cautiously optimistic, I guess, if we could call it that. We're not looking to invest large amounts of capital in the UK or even Europe at this stage, but we will be watching this space for opportunities as they arise. The Eurozone obviously doesn't have the tech giants of the United States, so we are seeing far less positive momentum in those markets, but still pockets of opportunity there, particularly in Western European markets. So watch this space, but nothing terribly exciting at this juncture, in our opinion, in terms of European markets. Looking a little closer to home, so in Asian markets, obviously China being at the forefront. The Chinese policy announcements, the Chinese growth announcements came out only recently, and we saw that the forecast for economic growth for the country this year is remaining at 5%. Now, given current growth rates, given current inflation rates, this would suggest that we are going to see more and more meaningful policy changes to stimulate more and more demand, more and more economic growth, particularly domestically in China. Inflation remains at record lows. We are seeing very little inflation. In fact, many countries would benefit from China exporting some of that deflation, in effect, or lack of inflation, to the rest of the world to start to bring down inflation levels in other countries. But we are watching this space for more and more policy change. Again, in China, given the fairly disappointing performance we've seen over the last few years, we would expect to see that there will be pockets of opportunity for investors with a long enough investment time horizon. Because as these policy changes come out, as more and more investors are looking for underpriced opportunities, then we will see more and more attention paid to China. As I said, Japan, obviously in the headlines for all the right reasons at the moment. We have seen strong performance, quite a number of buybacks with companies listed in Japan as well. And very strong equity markets in Japan over the last 12 to 18 months. Now, there is the expectation also that the yen will start to strengthen against a number of other major currencies. But what that will take first will be other countries' central banks starting to cut their rates. So potentially, as the Federal Reserve, for example, does start to cut rates, that potentially will drive the US dollar down relative to the yen. So again, investors should be positioning themselves accordingly. We think the Japanese stock market may have overrun. So again, potentially a profit-taking opportunity there for investors. But again, for us, watching this space at the moment. So that's a bit of an update of what's happening in Asian markets at the moment. Let's have a look at what's happening on the ground down in Australia. In Australian markets, one of the biggest stories has been the housing affordability, house prices, vacancy rates right across the country. Generally speaking, we see a market as a relatively tight market when we look at vacancy rates and availability of rentals for anything with a vacancy rate below 3%. Between about 3 and 5% is considered somewhat normal, below 3 considered very tight. And currently across most major cities in Australia, we've got vacancy rates of below 1%. In many pockets of Western Australia at the moment, we've got vacancy rates of 0.3%, and Brisbane is seeing a very tight market as well with rates below 0.7. So what this means is that we're seeing upward pressure on rental prices. Whenever there is anything that comes onto the market available for rent, we are seeing 20, 30, 50 applicants for that single property. Naturally, this raises challenges for Australian expats sending their kids back to Australia to study, or other nationalities sending their kids to Australian universities to study. But even for Australian expats repatriating to Australia, it does mean that we need to give more thought to where we're going to live. Can we find somewhere to rent? Do we stay with family? Or should we be buying our home before we go back to Australia? So these are all things we need to think about in this current market. given the current immigration figures, which is a positive for the Australian economy, not so great news if you're trying to rent a place. That immigration is likely to continue. Whilst it will drop from the numbers that we saw last year, it is very likely that we will start to settle at around 240, 250,000 people coming into the country each and every year, all of whom need a place to live, and we are just not building enough. And policy changes as they currently stand are a long way short of what we need to be building in terms of having sufficient housing. So we would expect this upward pressure is going to continue. So again, watch this space. The other major piece of information or major data point that we're watching in Australia is inflation. Inflation, like the rest of the world, is coming down very quickly, albeit Australia's energy policy is arguably a little less desirable than many other countries. What that has meant is that Australia's energy prices have risen quite quickly, and despite other countries have seen a decline, Australia's energy prices have remained quite high at both a household and a business level. So we are seeing inflation come down, but not as quickly as some other countries. So we are also seeing services inflation figures quite high, which again is partly driven by a lack of labour and of course wage prices or wage costs to businesses in Australia as well. So watch this space. Inflation is very much heading in the right direction in that it is declining in Australia rapidly. But will we get a rate cut in the next quarter or the second quarter in Australia? I think it's unlikely. Will we get one in Q3? Again, I think that's a bit of a coin toss at the moment. I think it is very likely, though, that we will have at least one rate cut by the end of this year. Now, that will obviously be good news for anyone with a mortgage, anyone with debt. I know I'm getting sick and tired of seeing the letters, the emails from the bank informing me that my mortgage repayments are going up, as I'm sure many others can feel and sympathise with that pain at the moment. The question, of course, is how many rate cuts will we get? Is that somewhere between 3 and 6 over the next 2 years? I think that's probably about right. So we're certainly not going back to COVID levels, but that will mean that interest rates start to cool, which is usually positive news for growth assets, being equities and property. So again, watch this space. Outside of this, we will also have an election in Australia at some point over the next 12 to 15 odd months. Again, will we see any meaningful policy change? Watch this space. We'll certainly be monitoring this closely. And of course, the new financial year is rapidly approaching. So the end of financial year in Australia is the 30th of June, which means that if we are looking to do things like make super contributions, like bring forward any tax deductions on our properties, it's a great time to start reviewing this before we get into the month of June, and it's a mad scramble. So if it is something you're looking at, obviously reach out, drop me a note, let's run the numbers and work out what is the sensible thing to do at this current point in time. So in Australia, in terms of markets, in terms of sectors that we like, again, we remain very bullish on healthcare, consumer staples with rising immigration, and of course the technology sector in Australia, where there are pockets of opportunity. Whilst it's a far cry from the technology sector in the United States, we still do see some great opportunities in the Australian market. So again, watch this space. Obviously the Aussie dollar will have an impact as well, but whilst the Australian dollar remains relatively soft, quite attractive for Australian expats, we do see some good opportunities there as well. So there you have it. That's a bit of an update of what is happening around the world and back in Australia as well. If you have any questions at all, do drop me a note, book in a time. Let's have a bit of a chat, a bit of a catch up as to what the rest of the year looks like, what your plans may be for this year. But I appreciate you tuning into this update. I hope you found it helpful. Drop me a note with any comments, questions, or anything you'd like to see in future updates. I appreciate you giving up your time to listen, and I look forward to chatting with you soon.